Robert Subbaraman is with us. Rob Subbaraman, head of global macro research at Nomura, Singapore. Thanks very much, Rob. Good morning. Great to have you here. Prashant here. I mean, since the last time we spoke, so much has happened, right? And so the only question now which remains is, will we see a softening of stance, or are they really pushing this through? And the indication seems to be they're not just happy. I mean, the Trump administration is not happy with a quick or easy. They're not looking for a quick or easy win. So they want to, I mean, the countries need to lower trade barriers, but more importantly and much tougher to do, they need to bring down non-trade barriers as well. So it's got to be a combination. Just saying, well, I'm going to take out my 10%, so you can, remove your reciprocal tariffs is not going to work, as we've seen with Vietnam, Rob. So what's the road ahead?
No, I fully agree with you. I think the goal of the Trump administration is to significantly reduce the U.S. trade deficit and to raise tariff revenues. And that suggests it's not a short-term thing. There's going to be structural elements to it. I think the other very important thing we are watching is whether there's going to be tit-for-tat retaliation. President Trump has upped the ante on China with this 50% tariff threat, which is a massive increase. That would take the US overall tariff rate on China to over 100%. That's very dangerous for the world economy. The two world's biggest economies in a full-blown trade war, and how integrated the world's supply chains are, there's going to be unintended fallout from all that. So we've been, at Nomura, we have been, I think, ahead of the curve in terms of expecting US tariffs to come hard and fast. But even us have been surprised at just the significant rise and breadth of the tariffs that have been announced.
What about your own forecast? Are you forecasting a recession, Rob, officially? What's the baseline?
Officially, no. For the US, you mean?
Yes, for the US.
Officially, no. Our baseline is very near a recession now. And it's clearly a risk, a big risk to our baseline view. The reasons why we're not forecasting a recession at this point are a few things. So one, hasn't shown up in the hard data significantly at this stage, more in the surveys. Two, if you look at the balance sheets of household and corporate sectors, they're still pretty healthy. Credit availability is still flowing quite well. And I think the other point I would make, which I think is underappreciated, is if you look at where the tariffs hit, that's manufacturing. That makes up 10% of the US economy. And goods consumption, which gets hit by the tariffs, that's about a third of overall private consumption. So it's a service-based economy. And so, it could get affected through second round effects, and that's clearly a risk. But at this stage, our call is more a significant slowdown to just averting recession. Our focus is more on the inflation side. We think inflation is going to rise substantially in Q2 and Q3. By the end of the year, you could have core PC inflation above 4%. So more than double the Fed's inflation target.
That's the big point of concern, Rob, isn't it? Good morning. So if inflation is doubling in the US, obviously demand would perhaps take a bit of a hit. Two-part question. What kind of a Fed response are you penciling in your analysis right now? And we haven't heard from the EU. They themselves are gearing up. They're giving final touches to their own retaliatory strike. With China, things are only escalating. So, how disruptive could these two big blocs be?
Yes. So on your first question, we, the US facing these stagflationary type pressures, inflation going up, growth going down, we think the Fed is not going to quickly come to the rescue. The Fed got burnt after COVID by thinking inflation was transitory. I think this time around it's going to be a lot more cautious, and it would need to see strong evidence of recession before it would be willing to cut rates. So in other words, I'm saying it's going to be more reactive than proactive to a growth slowdown. And so we don't have the Fed cutting rates until December, right at the end of the year, the next cut, which is a lot further out than what the market is pricing. So we see risk disappointment on that front. In terms of your question around Europe and the EU, you're right. I think that is also, I talked about China retaliation, tit for tat. What EU does is also going to be hugely important. Does the EU bend on its knee and do deals that accommodate the US, or is it going to retaliate? And one thing to remember is that US imports from the EU are actually more than from China. And so, the EU is significant. And if the EU retaliates and China's retaliating, that's going to make a much weaker global economy. The more that we get tit for tat retaliations, it's just bad for global growth and global trade and global growth. So, that is clearly a risk as well.
Hi, Rob. Morning. Nigel on this side, and good to see you. Well, first of all, I think the last time around you were warning us that you're expecting stricter tariff action from Trump. And bang on, I think you were in minority at that point of time, but that's the way it's played out. Give and take everything with regard to what's going on in the globe. Where does India stand? Because out here, we have got inflation under control. We've got the RBI that's likely to cut rates. And growth should be in that vicinity of around 6 to around 6.5%. How do you see the Indian economy placed, given the kind of political uncertainty as well as global uncertainty we do have?
Well, thanks firstly for acknowledging we've been ahead of the curve on tariffs. In terms of India, we have long said, and we stand by this call, that India, out of all the major economies around the world, is probably going to be least affected. And that means from a market perspective, ultimately could be a positive story. There's a few things going on here. I would say the first one is India is a very big economy, and it's a more domestic-orientated economy. So from that perspective, it's less affected by tariffs and trade wars than many other Asian economies. Second point I would say is oil prices have come down significantly. Inflation is around the RBI's target. I think there's a lot of room for the RBI to cut rates further. We're expecting a 25 basis point cut tomorrow and probably a shift from neutral to an accommodative stance. I would say the risk around our call is greater for a 50 basis point cut than no cut at all. And the final point I would make, and maybe the most significant, given the growing trade war between US and China, is that India, as a more neutral country and potentially, I guess, a bit more of a US ally, could actually benefit from global supply chain reshuffling, particularly away from China as multinationals look for another very big market and low-cost production area, and that is India. So, all those factors together make us feel that, all the big DM and EM countries around the world, India is probably the one that's going to come out of this least scathed.
Rob, I'm glad you made that point, and we have flashes on the screen supporting exactly what you're saying. This is a statement from the US State Department. And I mean, at least the body language, the commentary so far has been very reconciliatory between US and India. And the statement says that the U.S. Secretary of State, Marco Rubio, as well as our Foreign Affairs Minister, Mr. S. Jaishankar, have discussed reciprocal tariffs on India and how to make progress towards a fair and balanced trade partnership. So it's not, the skirmishes are nowhere near what we're seeing with the other trading partners. So yes, absolutely. Hope for the best, fingers crossed. Just a quick last point, Rob, from my end. You said that you're not expecting the Fed to quickly come in and douse the fire, that they will cut only in December. Is that consistent with your earlier point of expecting, a very low growth but escaping recession? If the Fed only cuts in December, won't it be too late? Won't the U.S. economy start going through some economic shocks then?
I mean, potentially that is a risk, but the way we see it for the Fed is, the worst possible outcome for them is with inflation going up. And we think the 3-month annualized core PCE inflation is going to rise to over 6% as we get into late Q2, early Q3. And inflation expectations, if you look at University of Michigan long-term inflation expectations of households, it's at over 4%. It's the highest since the early 90s. The risk around here is that inflation gets unanchored, inflation expectations, and then you're back to kind of the 1970s type oil price shock. And that's what this is. This tariff war is a supply side shock, negative supply side shock. And you can get into a scenario where you've got high inflation expectations, they're unmoored, inflation picks up, cost push inflation, and weak growth. And then ultimately, if the Fed cuts too soon, then it's going to have to hike very aggressively to get inflation back under control. Remember, Paul Volcker had to do that after the oil price shocks. I think after misreading the transitory inflation view after the pandemic or during the pandemic, Fed doesn't want to make that mistake again. So I think it's willing to tolerate that risk, accept that risk that they could be too slow in cutting. But, cutting too early, in my mind, for the Fed is an even bigger risk because further out, if they have inflation out of the genie bottle, they may have to hike very aggressively to get the genie back in that bottle.
All right, absolutely. We'll, of course, see how this plays out. But a great conversation, Rob, as always. Thank you very much for joining us and look forward to the next one.